Is there any trend to options trading automation in industry? Looks like large portion of volume still traded by hands in Bloomberg. It depends on in what kind of organization you work. If you work in the on the sell side, you have clients, especially corporate clients. They have specific and large deals. For example, they want some specific option structure, and it's really large in volume option structure. So you need to price it by hands and also trade it by hands. For for smaller deals and for algorithmic deals, you usually use algorithms. For example, for their clients, every bank, not every, but many banks have the special platform that has tradable options. Like you can just click a button and and the deal appears with clients. But these platforms usually have limits. It's just it's just a kind of risk management. And also you have algorithmic trading, and for algorithmic trading, for market making algorithms, it's no hands work in this field. There are many hedge funds that trade options that make market maker algorithms, and I even read an article about options market maker performance on Korean stock exchange, and some firms like Jane Street and Optiver trade options here and have market maker algorithms here. So yeah, trading automation in industry is really. Now I think we go to the next questions. Forward is a deal that obligates holder to execute trades on the future spot that wasn't defined upfront. Forward price is usually defined upfront, is always defined upfront, sorry. So it's this price is defined by spots in the moment of the deal, and also is defined by rates. If it's a fixed forward to rates. Next question. Generally speaking, market value of portfolio is defined by Greeks that are hedged. Market value of portfolio is defined not by Greeks, but by market parameters. Usually, you have your portfolio in your trading system. You have a kind of trading system that consists all of your trades, and you have market parameters that stream in this system. It's for a fixed portfolio, it's spot, FX rate curves, and volatility surface. And for this portfolio, you usually have the specific method to estimate your risk and to estimate your P&L. It calls mark to market. Mark to market is sorry, I'm kind of a bit worried, but I try. Mark to market is is a metric that compares the previous prices of all your deals that you have in your portfolio, calculated according to these parameters, with the next parameter that streams. For example, spot changed, and you have P&L from it, and all this P&L all this P&L sitting here. And the same for options, the same for forwards. And Greeks is just a measure of your risk, and is just a way to understand what financial result you will have if some of market parameters change.
Okay, and Daria, may I elaborate a bit more on this question?
Okay.
Yeah, those are my questions, and mainly I was interested in if we are willing to forecast the market value of our portfolio, then am I right that only Greeks define the change, the fluctuation of market value of the portfolio or not?
Um, it depends on market change. For example, in all this model that we use to estimate market value, we have a lot of assumptions. For
Yeah.
example, for this equation, we have no, for Black-Scholes we have many assumptions, but I think there is one assumption that we need more than other. It's assumption about price continuity. But in real world, we usually do not have price continuity. We sometimes have price jumps. For example, on the market's opening, and even when market opens, but there is a big magnitude in the spot change. That's why we just we just can't use Greeks because it's first, second, and third. How many? It depends on how many we use, but there's always an error with big price jumps in every hour prediction. Yeah, it's because it's because of real world. And
Interesting.
yeah.
Yeah, I just said that it's interesting because, yeah, primarily I know Black-Scholes model only from textbooks, and of course, when we consider stochastic processes, we don't consider that we have gaps in trading days and so on.
Yeah, but in real world we have gaps. For for example, with price of brands today we have a gap in opening, and I think some traders have options on brands, and this morning wasn't really happy for them. So but
Okay.
usually the big part of market value can be defined by Greeks, but not 100%.
Okay, thank you.
And there is also we have a question from Alex.
Yep, hello. I have one question. In real work, you are using ready models, or you are building models from scratch? That's the first question. And second one, in your models, you're using continuous time, or maybe you are using discrete time?
Okay, thank you for a question. The first one, usually we use ready models, but not for all. For example, why we need to use ready models? Because there are some markets, how to say, there are some market conventions, and every participant, every bank or corporate client trades according to these market conventions, and every price on exchange also match this market convention. So if you use your own model for pricing, you also need to match this with a market convention just to trade with other participants. And if you trade on a large market, it is for basic pricing, you usually use ready models. But sometimes you need to use your own models, for example, for some specific goals. For example, you may use your own models for skew, for spread construction. Sometimes you use your own models for volatility. For example, it really matters in Russian markets because we don't have liquid options markets on USD ruble now, and we don't have liquid option markets for some new currency pairs, for example, INR, ruble, and so on. And when we don't have volatility surface, we need to estimate it by ourselves, and sometimes we can use something different from Heston or Saber or something like this, some modifications. Yeah, and the second question is about continuous time. We use continuous time, but in day terms. It's really hard to use intraday pricing in models, for example, to make Black-Scholes in terms of minutes or seconds. It's really hard to systems that consist many deals and so on.
Thank you.
Okay, we also have another question in chat, and we have some questions in Google form. I answer the question in chat because I think it's short. And then we go to the questions in the Google form. Okay, what Greeks are more useful and informationful in your practice? Could you name them? When you go to the option desk, firstly, you need to understand delta, gamma, and theta because of this. Then you try to understand Vega, Vanna, and Volga, and also Rega and Sega parts of Vega. I think it's enough for for the first time. Yeah, I think that was the answer. So next question. Delta hedging implies the act of borrowing domestic currency to buy foreign one, right? I think it's in books, but in practice, delta hedging implies just spot deals. You may borrow currency and you may not borrow currency. You may have it in your book. or you just may net delta from 2 or 3 or all of your options. So in theory, you have borrowing. In real life, you also have borrowing, but you don't think about it if you work in a big bank. Yeah, and therefore we are obliged to pay an additional interest for the lender. So our graphs of delta for call option should intersect OY axis below 0. I think we should divide borrowing and delta. I forget to say, in option Greeks, we also use rho, the sensitivity to FX, or no, in my case, to FX rate. And I forgot about it because I trade usually short options, and we have not so much rho in them. Let's say that we have an empty book with no spot deals, with no options, and then we have only one option with this delta, and we need to hedge it. For example, we sell call. And now we need to buy delta. In practice of working in a bank, I usually buy delta and don't think about don't think too much about borrowing money. I will have the effect of borrowing money in the end of the day, because we have another desk that makes our funding. So in the end of the day, I will have a financial result from funding this trades for buying delta. And I think I think in our graphs of delta, we do not use this fact because it's just easy to understand, to have the funding and the Greek itself separately. But in our P&L, we will have this result. And it will be another deal in our portfolio. It will be the deal of exactly borrowing money, and as a risk measure, it goes to this one. So we also will have the table for rho, or another name is DVO1. And for example, if we buy USD RUB, we need to borrow RUB, and here we have the sensitivity to RUB curve, and we will borrow RUB overnight. Here we have overnight tenor, and here we have this risk. Okay, I think we can go to the next question. Delivery option differs from the cash settled only the asset exchange. In first case, we are obliged to transfer the base asset. In the second case, only the equivalent price of the best asset. It's true, but we have it's a little tricky in the expiration day. Delivery option for example, let's say we also sell call USD RUP, let's say CNH RUP. We strike 11.45, and let's say that its delivery option, it's the nominal of its option is 1 mu CNH, and today is the day of maturity, and spot spot was 11.44, so our option expires, and when we made this deal, for example, the spot was also 11.45. We have delta like 500,000 CNH. We hedge it. We just this is our delta. From option we have minus 500,000 CNH, and then we hedge it. We buy 500,000 CNH. The time goes to maturity, and our total delta is 0. The time goes to maturity. We hedge delta all the way to maturity. So for option, we have delta 0, and for spot we also have delta. We also have delta 0, but let's say another term. I think say that spot at time t. Say the spot at time t is 11.45. So we have delta like short 1 mu CNH, and here we made hedge long 1 mu CNH. And when it comes to delivery, we have total delta like 0. If we have cash settled option, our delta will change because here we have all the same from option before expiration, before cash settlements, we have short 1 mu CNH. And for delta and for spot, we hedged, so we have long 1 mu CNH. But our option is cash settled, so after the settlement, we don't have this position. We have and in total, we just have long from our delta hedge. This is a tricky thing. We need to know it in the morning before the expiration, just to hedge the fixing risk. in this day.
Honestly, I didn't quite understand what we've done here. So once again, we have one option, call option. 500K is its market value, right?
I
Or
think no, 500K is delta of this
okay,
option in the day of the trade because
okay.
it's like ATM.
Okay, then on timestamp 0, we have minus 500K because of what? Because we've
It's delta from option. It's option position. It's delta from option position.
okay, so it's because we went short on CNN.
It's like CNH, Chinese yuan.
CNH. Yeah, sorry. Okay,
Yeah,
and
we
yeah,
have this position because we sell call option. When we sell call option, we have a short delta exposure in the first currency.
okay.
Then
Okay.
we have a spot deal to hedge this delta. We buy 500,000 CNH. Yeah, and so when times go to expiration, let's say that in the last day we clearly understand that our option our call will be exercised. So because spot is 11.46, for example, that's why we have delta in the full nominal of the option, and we also hedged it before this point to have the total portfolio delta equals to 0. So here we have minus 1 million CNH from an option, and here we have long 1 million CNH from the delta hedge by spot. And for delivery option, we have a delivery in 1 million CNH, so nothing changed, and our delta equals to 0. Our total delta. We have just spot delivery from this option equals 1 million CNH. But when we speak about cash settled option, we will not have this delivery of 1 million CNH. We deliver the RAB difference. So when the settle,
okay.
yeah, and that's
Okay.
why we don't have this, and we have spot position, and in the start of the day, we just need to know this, that we have fixing risk, that's after fixing our position, our option delta just just goes out, and we have only spot delta.
Okay. Okay, thank you.
Next question. In terms of Black-Scholes model, is there much different in assets we are trading on the nature of assets matter only in terms of understanding and micro and macroeconomy? Not also in micro and macroeconomy. There are some features of another assets. For example, for stocks, we usually have dividends. and we need to add it into our Black-Scholes framework. For commodity options, we have something like inventory costs if the option is delivery, and we also need to add this into Black-Scholes. For options on futures, we usually have a specific kind of model. It's black model when the base asset is futures, not spot. So, but intuitively, the principle of Black-Scholes is the same.
Okay, thanks. And also there is a second big part of the questions. You may skip it fully, maybe just to only pay time for the last question, if you prefer, or you can fully skip this part.
Okay, I think we have time. The next portion of questions is a kind of like how to say, sorry. It's like from a book for interviews, so I think I can answer it shortly, and then and then I can say what books can you use to know the full answer, and then we go to the second part of question. I think if you have, for example, half an hour.
Yeah, honestly, I'm just a bit baffled. I didn't understand what you meant. If I'm not mistaken, currently we are finished with the first part of the questions, right?
Yeah, and then I have a kind of question from another person, and they are kind of
Okay. So you meant that we
simple.
can. Okay, you meant that we can switch on those kind of questions, and then if we have half an hour, then we can go back to the second section of my questions, right?
Yeah, yeah.
Okay,
Sorry.
okay, understood. Yeah, sounds good.
Okay. So what math is most used in quant finance? Give simple examples. Probably in options, you need stochastic calculus and probability theory. I think it's the most important when we talk about constructing volatility surface and understanding Greeks. How are gamma and delta related? This thing. Yeah. And next question. What is the main trade-off when choosing hedging frequency? It's kind of interesting question. Usually main trade-off is trader spread and how long can you sit on the position. For example, you may hedge by limit order and to earn spread, but you may not you may not do hedge this way, and that's why you can use market orders, but you pay spread and you also pay transaction costs because you are a price taker. So that's so here is the trade-off between these parts. Why is Black-Scholes not perfect for real markets? Because of constant volatility. We need different models. We need stochastic models. And because of price continuity, it just don't. No, we speak about price jumps already. Okay, why are market makers often short gamma? What does this mean for them? Market makers not often short gamma, to be honest. I think market makers try to have gamma that match the market. And in practice, you usually have long gamma. So what does this mean? When you short gamma, you in the first time you have theta, and you have PNL from theta, positive PNL, and you have negative PNL from delta hedging, and that's vice versa. If you have long gamma, you have positive PNL from delta hedging and negative PNL from theta. Okay, how do market makers use bid-ask spread to cover risks and costs? Market makers usually have models for bid-ask spread just to make it wider, for example, in high volatility conditions. It's also kind of an easy question. Okay, the next question. How do you make a data neutral position using an option and a forward? You make a forward deal, exactly. And why do traders look at portfolio risk instead of single option risk? Because you have too many deals. For example, 1,000, not one, I think 100,000 deals, and it is what, and we begins from it. We begins from this views with begins from this table views with risk that can separate all our deals into Greeks and hedge them separately. It's more convenient when you have thousands deals or even 100,000. Okay, and what is market impact? Market impact, it's, for example, when you hedge delta, if you have large option position, you need to, you have huge delta, and when you hedge it, you can change the market price by your deals. It's interesting, and sometimes this effect is sometimes we have volatility correction for this effect, because you may by your deals you may grow volatility yourself if you have large option position and you need to hedge delta and impact the market. Okay, why do traders prefer volatility versus delta instead of volatility versus strike? It's also an interesting question, because in terms of volatility versus delta, it's easier to think about probabilities. There are two ways of construct volatility surface. It's like sticky delta and sticky strike. I recommend to read about these two methods also in FX derivatives trader school. Okay, and I think there are two another questions about volatility, but we discussed them earlier. How do you identify tail risk in a real trading strategy? Usually to identify tail risk, you have stress tests of your portfolio. You just change market parameters like spot, volatility, and so on. And in this stress test, you see what Greeks and what PNL you see with this market parameters changed. And this stress test can be helpful, for example, if you book have barrier options, and also they can be helpful if you have pin risk today. You can see using this stress test, you can see large jumps in some of your deals because of barrier options and because of pin risk, and that's a kind of tail risk. Also, sometimes we have an events that weren't priced in our surface. These events also and this event's also about tail risk. Do you actually risk manage your Vanna Volga exposure? Usually traders risk manage Vanna Volga exposure if they can. If they have liquid options market, if they have another participants, another banks that have trades Vanna and Volga exposures separately on the OTC market, Vanna Volga exposure is managed. So if you want to work on liquid markets, or if you work on illiquid market, but you can trade with the other banks that also have a large option position, you actually risk manage these exposures. Okay, next question. What is the culture on the desk? You work as the one organism with your colleagues, or you are segregation and independent of the others? How crucial and sorry? How crucial and important is the communication skill for a trader? You work usually you work in segregation with your colleagues, but you have some specific expertise. For example, our desk is divided by spot traders and derivatives traders, and derivatives traders are divided into options traders and short-term interest rate traders, and so we are responsible for our part of risk. For example, my part is volatility risk, and my colleagues responsible for the delta risk and for the raw risks. But we also but we have but we also work together because it's about the position of the full FX desk. We have the limits on desk, not on separate traders, and we act in this limit, and also we try to we try to, for example, to set up new products, to trade another assets, to discover another markets, and these are
So
these
like
are
develop new features, and therefore you
yeah
need to communicate. Okay.
develop new features, exactly. And
Mhm.
we need to plan them together, and also we need to we need to we need resources from other commons, for example, quant researchers, quant developers, business managers, and so on, just to make it possible to develop these new features and open new markets.
Okay,
So
so
you
you
need the
can freely.
communication skill, exactly.
Okay. So you can freely exchange the information, the insights of your department, right?
Yeah, that's
Okay.
true.
Okay.
Okay, the next question. Current market conditions require outstanding skill set. Lead code, MLDL, stochastic differential equations. How important is in-depth fundamental knowledge in terms of professional development as a trader or quant researcher? It really depends on your role. For example, and it depends also where you work. For example, if you are a trader, you usually have to know um, you have to know just some simple programming language. If you work not as a HFT algorithmic trader.
Mhm.
So if you work just a simple trader and not develop the algorithm by your hands, if you have the special team of quant developers for it, you usually it is not necessary to you to know, for example, C++, but it's usually necessary to you to know something like Python for analytics. If you are options trader, you need to know stochastic differential equations. If you are a spot trader, you may not to know it.
But on what level should be my knowledge? For instance, so that I can delve into some very specific topics of stochastic calculus. I don't know, like what is a how to say, when you're taking a derivative differentiation. Don't know how to pronounce it. Uh, because as I know, in stochastic calculus, the process of taking a derivative of the stochastic process itself, it's not the same as taking just basic derivative of function. So
Okay.
yeah, so what I was asking, on what level of understanding the theory you should be as a trader?
I understand you. If you are a trader, you can intuitively understand stochastic differential
Okay.
equations. You have no need to divide new equations. You have no
Mhm.
need to solve every equation. But if you are a quant researcher, you do.
Mhm. Okay.
And the next question is about ability in low-level programming. I think I already answered.
Yeah. Yeah.
Yeah. So the next question is about main differences in global hedge funds and investment banks in terms of ultimate goals. And if you possess the information, what are differences in working hours and salary? Firstly, about goals. global hedge funds is buy side, and investment banks are sell side. And when you when you work on the sell side, you cannot choose your position. You have position from clients, and you need to hedge position from clients. Having position from clients is usually about the fact that you don't want this position, because when you have kind of market panic or something like this, for example, if USD ruble price grows, clients usually also are in panic, and they buy USD ruble forwards and spots from you, and you have a large short of USD ruble position, and you need to deal with it in some way. And
So
yeah,
you're entering a risk position without your willing. You are just forced to enter this position, and for instance, hedge funds, they can select whether they want to enter and take those risks or not.
hedge funds, they trade and they earn P&L for their own capital. So that's why they have capital, and they choose the asset to invest this capital. This is buy side, and it also can be the capital of their clients, and it can be the capital of their own. But if you work on the sales side, you also usually have deals with your clients. You are a market maker. You are in the one side, and your client is on the other side. So that's why you, in market panics moment, you have the position. You usually have the position against the market. It's first, and when you work on the sell side and you are a market maker, you have your P&L from the spread that you earn. And when you work on the buy side, you have your P&L from your direct position that you want.
Okay.
And the next part of this question is about differences in working hours and salary.
Yeah.
I think you literally can Google this question. There are some information provided on different sites about salary, especially sometimes the companies disclose the salary in their in their vacancies. And there is one thing that you need to know is when you work on the buy side. Firstly, the big part of your salary in both organizations is bonus, and when you work on the buy side, your bonus is also is usually linked to your performance. So if you have bad performance, the results, P&L performance, I mean, the results in the end of the year, you will be not happy with this result. And in investment bank, on the sell side, you also have the bonus, and but usually it does not have so direct link to your P&L. Sometimes it's not in this way.
So in the bank, there is more, how to say, the hierarchy, how to pronounce it, like hierarchical structure when you have like junior, middle, senior, and blah blah blah, but the grades, yeah. So it's like the grades matters more in banks, but in hedge funds, your performance may affect your bonus, mm, how to say, more significantly.
Um, it's partly true. In hedge funds, you also have grades like analyst, associate, portfolio manager, and so on. And your grade is linked to
Yeah, I understand.
to the size of risk that you can have, to the limits of your book, exactly. And the limits of your book also limits your exposure, and that's why it also limits your P&L potential and your potential loss. And that's why it also limits your bonus. But you may have more huge bonus because of your performance. That is true.
Okay.
And also, hedge funds are usually more competitive. Usually, you have something like not fixed working hours. And I think the main problem is competitiveness. Because if you have usually not usually, if you have a bad result in the end of the year in your P&L,
You'll be replaced.
you may be fired.
Okay. And comparing the working hours in hedge funds and investment bank. So in investment bank, you have like fixed amount of hours and you cannot be worried about them. You just calmly work. But in hedge funds, it's common to overwork. And if there is no such, maybe there is such term as fixed working hours, but if you work a fixed amount of hours, you may be replaced by more talented and hard-working guys.
It's also kind of true, but not in 100%. In investment banks, you also have some overworking, but I think global hedge funds are just more stressful because you have more responsibility to the result, and because it depends on your final bonus, and because it also depends of will you have this work or not.
And in investment bank, you do you risk career as much? Not as much, but comparable with the risk as in hedge fund, or you are secured in some level on some level in investment bank.
You are not secured in total, but you feel like a bit more secured.